I'm streaming. That's cool. Well, I don't know if I'm streaming or not. No idea. How do I tell if I'm streaming? Anyone there? Says I'm streaming. That looks good. Is there a chat window? All right, there we go. All right, I think I am live. That's cool. Let's, I don't think the quality is all that good. All right, what I wanted to do, sorry this is taking so long, is I want to review Nike. So let us see if I can put this off to the side and actually do a one-pager for you guys. What do I think of gold? Well, first of all, is the camera really glitchy? Am I getting enough bandwidth here, or how does it look from your end? No, it's smooth. Okay, good. All right, let's start. This is the first time going live, so please forgive me. This is a definite learning curve for me. But we're trying something new. I wanted to build Nike tonight and just kind of talk through it. Looks and sounds great. Thank you. Appreciate that. All right, let's dive in. I'm going to screen share. Let's go get some data and see if we can't build out Nike stock. I honestly haven't looked at it. This is going to be just we're going to do this as we normally would. Let me just make sure I've got kind of everything where I want it. Don't need that. And put this over here. Sorry, just get some screens in place so I can do this. All right, let's start. Let's do a little screen share. There's the old cash flow one pager. Put that in a frame for you. Let's go get some financials first. So I got Nike up here. What I'm going to do is let's go get some cash flow pages for this. Financials, let's export this. This is what? Income statement. Let's take the Excel. Open up the file. What I like to do is just first get all the statements together before we start doing things. So I'm going to take this, use my Excel hotkeys, and just move this over into here, and I'll label it income statement so I know it's that. Let's go back to the internet. Got that one. Let's get the balance sheet. Export balance sheet. Download the file. Hi, Amit. How you doing? Get the balance sheet. And done balance sheet. Let's move the balance sheet over to our one pager. And we'll label it just a balance sheet. That'll work. Go back to the stock market. And let's get the last cash flow statement. Again, just getting some data. There's lots of data providers you can use. I've been using Finbox for a little while, but I actually just bought the subscription to Yahoo Finance. They're giving 40 years of data in their gold plan, so I'm going to try that out, see how that runs. But this is my cash flow. Oops. Cash flow. All right, so we got our three statements here: income statement, balance sheet, and cash flow. Let me. What we're gonna do is we're gonna pull these together, and I need stock price data. So let's go over to Yahoo Finance and download historical, all-time, monthly. Let's download that. I think you guys could see all this, right? Let me put this screen over a bit. That's probably better. That's what you want. I think that's running. All right. I'll show again. I don't care about that. So what do we want? We want, this is all-time data. I don't want the open, high, or close. I just want the adjusted close and the date. I'll take all this, come over into my model, and I'm going to paste it over all this stuff here. So just... Oops. Where's my data? There it is. Copy. I like to paste value. It's just a bit easier. Paste value and update the little pricing matrix. And their end of year is actually May. So run that out so I get a couple more years here. $93 currently. Interesting price. 10-year chart, doing just fine. Okay, now let's go to our one pager. So what do we got? Any questions from the booth yet? Nope, you guys are good. Okay, cool. This is fun. All right, let's do this. Let's get let's pull the income statement around. So what I like to do is I like to organize the income statement by just rotating it. 90 degrees, so it's over in this format. Because what I'm going to do is I'm going to pull this number here and drop that into my revenue section. So 2015, let's go over, pick up 2015's revenue, which is here, 30. Oh, that's not numerically formatted yet. Let's change that format. All these numbers, make them dollars, or numerical values. There we go. So we've got 30,600 million for revenue in 2015. Then it goes to 32, 34, 36, 39, 37, 44, 46, 51, and 51. The market freaked out over this. Wow. It's growing revenue 6% annually over the last decade. It has one stumbling here where it goes from 51.2 billion to 51.3 billion, and the market has a meltdown. Okay, this is going to be interesting. Let's see what else we got. Pull this over here. All right, let's get the EBITDA. So EBITDA, I'm just going to link it over to my little data set. Where's my EBITDA admin? EBITDA, here it is. There we go, that's good. Market worried about tariffs. Market's always worried about something. The trick is if you have a good business, they can price through the tariffs, or people will pay for it, or maybe they can get around the tariffs. But I wouldn't worry too much about them. Let's see. So that's revenue and EBITDA. If we look at EBITDA, 4.8 billion, 5.1, 5.46, 5.2, 5.4, 4, a little down there. 8 doubled, nice. 7.5 down a little bit. 6.7 down 2 years in a row. Okay. And 7.9. So they kind of hovered, but still growing single digit 5% a year. Not terrible. Oh, not the 10% tariff. Trump's raising it again if China does tariffs on the U.S. Yeah, true. There's going to be some back and forth there. I actually think in both administrations, both Trump and Biden, have been talking about repatriating manufacturing capacity back to the United States. So I think there's an opportunity here to look into companies that make things in the United States or contribute to that. So is it tool manufacturers? Is it construction equipment companies, Caterpillar, the like? Like these guys are starting to really grow, and with the trillions of dollars of investment announcement that's been happening, I think you're going to see more and more construction out there. I think that's what we need. Oh, share count. We need shares outstanding. That's on the income statement. So I want fully diluted shares. None of this, just share count. So weighted average, fully diluted is here. Drop those. Are they buying back shares? They are buying back shares. Look at this. So 1.7 billion shares, 1.7, 1.69, 1.65, 1.61, 1.5. So they are buying back shares at a 2% clip per year. That's great. Let's do the balance sheet. Again, I rotate the balance sheet just because my data is kind of over. I like it kind of in time. So time is kind of vertically sometimes. It makes it a bit easier for me to see patterns. So getting that together, let's take a look at their total cash. So what I'll do is I'll sum up cash and short-term investments to see what total cash do they have. $11.5 billion. That's interesting. We're going to set, this will be like total cash here. So I'll put total cash, and I'll put min cash here, and this would be excess. So if I said I want them to have, $4 billion of excess of minimum cash, then the excess is here. That's how I'm kind of going to set it, and I'll get that in a second. So So there you go, and that might grow a little bit as they grow. That might be 4.5 billion. Keep that for a couple years, and then I want them to have 5 billion. You can kind of play with this and see how excess cash grows. Intel needs some time to build all that installed capacity that they want to build out. They've got to really work on that. Let's see. Let's get the debt. That's what I came here for. So let's walk over to, let's take a look at liabilities, total liabilities. I'm just going to make some room here. What I like to do is come in here and say the sum. I've got, here's my short-term debt portion, short-term borrowing, current portion of long-term. I want this here, and I want long-term, and I want capital leases. I'm going to pick all that up. Just like that. And I'll come over to my one pager and I'll drop in debt, this number, knowing that some of this is actually long-term leases. This step up here is pretty high. Actual long-term debt is 7.9 billion of the 12. So 7.9. Okay, so it's 2/3 of the total debt. Excess cash, I'll link to the excess cash number that I have, and I can tweak it in a little bit if I need to. Market cap, we'll pull the stock. Let's see, I can do market cap. I've got stock price. Let's pull stock price. Again, as of May, their fiscal year end. I want May 2015. So I have it over here, stock price, May 2015. It's 44 bucks. Oops, what happened? 44 bucks. That's right, there it is. You give me data for Nike. Their 5-year PE is 31. It's around normal price. Forward growth rate's negative 3%. Gotta hope not. Forward EBITDA 9%, negative 9% growth. There's 5-year EBITDA 11%. Gross margin still over 40%. This is for Nike. I don't like the negative growth, but 40% growth margin I'll take. Let's see what we get. Let's look at cash flow. So we'll take cash flow, kind of organize it the same way we do it. So this is laid out with columns being the year. I want to revert this, just transpose it with the old Excel formula. And what I'll do is all this data in Excel doesn't actually recognize it as numerical values because I'm kind of pulling it from a website. So I just multiply by 1 and I get my numerical value. What I like to do is just take operating cash flow and subtract it from stock-based compensation to get an adjusted value. Cash flow is still growing. So let's put my adjusted free cash flow and drop that in there before we start taking a look. Then we'll do CapEx. What do you think of the new CEO, by the way, of Nike? What's the Elliott Hill? CapEx. I looked at his bio. He's kind of a lifer at, he's a lifer at Nike. He hasn't really done anything that I can see outside of the business. Oh, you like him? Like the new CEO? I thought the new CEO was Elliott Hill. You're saying it's Bill? Did I read the wrong press release? Let's get cash change in debt levels here in the cash flow statement, and then we'll figure out who the CEO is in a second. Long-term debt change, repurchase stock, nice. And of course they've got their dividend. But, they have no debt, it looks like. At least they're not paying down any debt. Yeah, they have no debt. That's a boon. I'll take that. All right, so what do we have here? Let's look at this. Can you guys see this all right? I need to zoom in. I'll zoom in a little bit because it's a little tough to see. We're not creating a forecast. We're just kind of taking a look. Oh, Bill Ackman. Oh, sorry. Yeah. That dude's got like $1 billion in, something like that. Thank you. Yeah, no, Bill Ackman knows what he's doing. That guy loves undervalued stocks. He's very, very bright about how he researches and buys the stocks. Like, I have no doubt that guy would even get, fight to be on the board seats or change board members. He's got the clout to do that. So I like that he's actually in the stock. Thank you for that comment. Yeah, you're absolutely right. So let's see what is this telling us. Let's take a look at this data for a second. I like to start here at revenue, and just like I said earlier, revenue seems to be growing at 6%. You got a little stumble there. If I back up though, and say let's take 9 year. Just change this formula quickly. 7%, 6.6. So that 1 year does seem to cost us a little bit in terms of growth rate, but it's mid single digits. So it's no rock star in terms of growth, but at least it's consistent. 5% of the EBITDA. Okay. Debt levels, cash, market cap. Debt to EBITDA is almost zero. I love to see that, right? That means you've got a stock with tremendous assets. Let's go get their actual. I have the assets here. Let's see what we got. So, goodwill, not actually that high. That's nice. What do they got here? This is, I'm just going to multiply everything by 1 so it makes it easier to read. All right, so cash in the last annual report. I could probably put the quarterly one, but I'm going to stick with this annual one for now. Receivables, AR, $4.4 billion. It's kind of flat, up a little bit over time, so I think that's pretty stable. Inventory, that's up. I don't love that. Look at this. Inventory is almost doubled in 10 years. What's revenue? Revenue's up 30 million to 50 million. So it would make sense that inventory would grow to support that revenue. Okay, that doesn't seem out of line to me. It seems like they're selling through their product. I think you're right with the non-extent. This looks to me like there's a huge inventory glut in the pandemic, right? That's this number here. Just highlight it for you. That's a terrible color. Sorry. So there's a 8.4 billion of inventory. It spikes, and they're kind of working their way through this. It's going to take some time, but at the same point, revenue has gone from 30 billion to 50 billion. So it's not, their inventory is not going to go back to 4. It doesn't belong there. The revenue's higher. It's a bigger business. But I see your point. They need to sell through that. Prepaid expenses, okay. That seems normal. Current assets, total current assets, $25 billion. That's up 10 billion year over year. Okay, I'll take that. Property, plant, and equipment, 7.7 billion. Goodwill is very low. Intangibles very low. Other long-term assets, that's probably rental leases. That's their rental agreements that they've signed. It has more legs than Crocs. It absolutely does. They have a name brand that Crocs does not have. Also, Crocs is kind of a plastic injection molding. And Crocs bought, is it Dude shoe that they're kind of betting on that. I don't know if that's going to have the same lift that Crocs did. So I think their management got greedy with their money and is distracting themselves from their core business. So I'm not a fan of that acquisition. But what I like here is I like the total assets here. And what I like about this is, look at this, very little of their total assets is goodwill and intangibles, which, yeah, so they have 38 billion. So you're an equity investor buying a company with very little debt. If, God forbid, they should go bankrupt, there's $38 billion there of assets that you could conceivably get some money back from. Nike and Adidas have collectively lost 20% of their market share running footwear and emerging brands like Hoka and OnCloud. Yeah, totally agree. I have Hokas. They're amazing shoes. Got lots of people who have OnCloud. Let me shut some stuff down. I'm getting a lot of I'm gonna make sure this is running properly. Yeah, isn't Hoka is Deckers, right? They bought that sucker, and it's been a complete rocket ship for them. So let's finish the working capital here. This is fun, by the way. I like this. A little live stream. Let's see. So AP, that's their payables, to vendors, not employees. It's vendors that they owe, and that hasn't moved at all. So they're have an inventory crunch, sales is down, but they're not actually delaying payables to their vendors. They're not in financial distress at all. Accrued expenses would include your payroll for employees. Nothing there. Short-term borrowings, nothing. Current portion of long-term debt is $1 billion, but they have plenty of cash on hand to make that payment. Lease, current assets, total current assets, $10 billion. Total current that was the liabilities. Total current assets, $25 billion. They have 2.5 times coverage on their current liabilities. That's a phenomenal position to be in. Long-term debt, we discussed, is very low relative to earnings. Capital leases, that's just rent on buildings that the accountants force them to capitalize. So total liabilities here is, wow. Well, ladies and gentlemen, total liabilities is actually less than current assets. That is like a Benjamin Graham number. Look at that. Look at that. Huh? Little Ben Graham call out. Right there, current assets greater than long-term liabilities. That is interesting. That is what Ackman sees. He's a huge Ben Graham fan. I'm going to highlight both these. I'll put this in green. That's just cool. You see, outside of the Facebooks, the Metas, when's the last time you saw a consumer product company that had more current assets than total liabilities? Very rarely. Very rarely. Let's keep rolling. So, equity account, let's see, equity, $14.4 billion and growing despite the fact that they're paying a dividend. Love that. Love. Let's take a look at their income statement. What do we got here? First, multiply this by 1 just so I can see the numbers a bit easier. Make them all accounting numbers because that way zeros or dashes. These are, that's 0. These are percentages. And we'll take this, format, let's get rid of this, that. Okay, so let's see what we get. So growth 0, goose egg year over year, 10, 5, 19, negative, that was the pandemic right there. Yeah, so they're like upper single digits, I think is a decent, what's the liquidation value? You would not really want liquidation value here, but, it's an interesting point. So what they normally do is they normally assign percentages. If you go through bankruptcy, right, they'll take some sort of percentage, like 100%, like this, and they'll say, okay, you've got liquidation value is a percent of this, and I'll take, just for illustration purposes, I'll just take this down by 5% as I come through the current assets. And then I'll give zero credit. Here, long-term assets, these are rental agreements. That's probably 50%, maybe 20% if you could get it. Liabilities are typically 100%. Here, 100%. And then maybe you get some sort of settlement, 95% here. Your capital leases, I'll do 50% or 25% to Matt. Oops, that's zero. That's 25% there. Current liabilities, current debt, they're going to want most all of it, so it's 90%. There's your capital leases. What was this? This is other current liabilities. I don't know what that is. I'll put 80%. But this is how they do liquidation value. There would be more total other current liabilities. There would be more diligence here, obviously. But then you say, okay, I'll assign a liquidation preference or a liquidity value to the numbers. And I'll go down and I'll say total, let's multiply, times this. So there's my assets. There's my current assets, my current rest of total assets. And I have a asset value, if liquidated, of $24 billion of cash. You do the same thing for liabilities, and you get probably 19 billion. So you've got, if you went bankrupt, and this is really, really rough math, right? You've got an excess of $4.6 billion of cash. You've got, how many shares of stock outstanding? 1.5 billion. So you get $3 of cash is your cash back. Again, that's a hard liquidation sale. I would see that as almost impossible for Nike, right? But that's, if you're asking how they do liquidation value, that's kind of what they do. But I want to finish the P&L. I got distracted here. Where was I? Income statement. Margin, you said plus 40%. Ding, ding, ding. Great job. You called that one. 45% on a gross profit margin is, pretty strong for a retailer, right? R&D expense, you'd expect that. Other income expense. Why is other SG&A? That must be here. This is miscoded. This is probably it says other income expense. That's probably the general operating expense category. And that's doubled over the last decade. That's not fun. Well, the stock price in the balance sheet, I guess, would be theoretically the liquidation value, right? So that's $3-4. So their operating expense, there's probably a lot here that a new CEO could cut out if they were serious about running the business leaner and generating more free cash flow. To double your operating expenses. Yeah, because you have selling and marketing expense. Okay, that's going to the athletes, paying those guys. But then when you actually run the business, the executives, the staff, headquarters, legal, stock options, insurance, rent, all the day-to-day folks that run the company, that's up. That's double. And revenue hasn't doubled. Has earnings doubled? Not really. See that? 4.8 of EBITDA to 7.6, not doubled. Revenue 330 to 51, not doubled. Cash flow 4.4 to 6.6, not doubled. Yet their operating expense has doubled. So, I see Bill Ackman calling up and saying, "Hey, you got to cut 10% of your headcount, of your headcount OpEx. That would put you at 10 point almost 11 billion of operating expenses. Then you're up 65% year over year. That feels much more in line with the revenue and earnings growth. So that's what I say, 10%. Yeah, 10% haircut. That's totally doable. If they announced layoffs and systematizing, blah, 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 whatever, has a long history. Yeah, Elliott has a long history of Nike. He joined the company in 88, an intern, wow, and spent there. So he would know where the bodies are buried and perhaps departments that are redundant or could be reduced, because there's probably a huge opportunity at that number if he has the stones to actually do it. A lot of people don't, but you'll know in the first year if he has the stones to do it. Okay, so then they earn 6.5 billion interest, really nothing else. So it seems really clean to me. And then weighted diluted shares, we said that's declining. Last thing, let's check out the cash flow statement. Just look through some of the detail here. Again, I'll multiply by 1 just because when I copy these over, they don't show up as numerical values in Excel. I gotta do this so I can turn them into dollars. All right, so 2024, where's my working capital? Other cash flow from operations. So this bit here is my working capital. I'll just highlight that so we can see it. You see the gray? Yeah, it's gray. You can see it. Stock-based comp. Oh, give me a break. What? Holy shit. Come on, guys. What are you doing? What are you doing? $191 million of stock-based comp last decade. That's grown to $800 million. And revenue isn't even doubled. You're up 300%, guys. What are you're just paying yourself? What? Look at that. Look at that growth. Come on. Where's the financial discipline? Where's the shareholders that you care about? They're funding this enterprise. You're just paying yourself. So, revenue's not doubling. You're not a rocket, and you're paying $800 million of stock-based comp out. Oh, man. Really hate to see that. What's that as a percent of revenue? 2% of revenue. Look at that. It was 0.6% of revenue. It's now 1.6% of revenue. They're paying a full 1% extra of revenue, not earnings. Revenue. Let's, for funsies, take a look at earnings. Stock-based comp. Divide by, what do we want to pick? EBITDA. We'll take operating income, right? A little harder metric. 5% to 12% of operating profit is going to the employees on top of their normal salary. Like, I have a problem with that. I think that's too rich. I'd like to see Bill Ackman cut that back. Especially if you're not growing, your stock-based comp is grown, and that number is inside this operating here, so it's in there. But this has also grown too much. I say they target that if they have releases. Does anybody know, by the way, if they already announced any kind of layoffs or restructuring, whatever? That'd be a key that they're taking this seriously, and I'd be really very interested in knowing if they've done that. Let's finish out the working capital. So working capital here, what do we got? AR, that kind of bounces back and forth, not too bad, but it's negative here, so just keep that in mind. It probably swings positive next year. Inventory change, they bought inventory. They bought $1 billion, $900 million worth of inventory in 2024. But you're right, here they're selling down. In 2022 and 2023, they were not buying inventory, they were churning through it. So that looks like that stopped if they've purchased inventory this year. Net change of other operations, that's also negative. Other operating activities also negative. So they've got a lot of negatives here that are kind of weighing down on the free cash flow. That will cycle probably positive next year. It kind of oscillates back and forth. So this 7.4, Might be a little low, actually, which is a good thing. CapEx, 812 million. They're definitely cutting back in CapEx to preserve cash. Check that out. So as times got lean, right? As times got lean, they cut back on CapEx. CapEx was nice. It was growing. It was healthy. Here, up to $1 billion. Pandemic hit. Okay, burn through inventory, cut back on CapEx, do the bare minimum. They're kind of doing that. And it looks like it's growing a little bit. So maybe they're getting back in the swing of things. But they definitely, did some hard maneuvering here to keep cash flow positive with selling down inventory, not buying anymore, cut back CapEx to keep cash flow positive, and be able to kick out the dividend, which they actually grew during this time frame. I would have liked to see them not grow it in the pandemic, be prudent with my cash, and then pay me out a catch-up dividend a couple years from now. But I guess they didn't want to do that. They just kept it rolling. Okay, but they pay $2 billion a year in dividends. And then repurchasing stock, okay, this is where they cut back. So you can see they were buying back $4 billion of stock a year. $3 billion. Pandemic hit, they bought $600 million. Honestly, they probably should have bought back the stock there. Don't pay the dividend. Switch to stock buyback when the stock price is way down, and then give the dividend back when the stock price goes up. But nevertheless, they've moved this up, and so what are they kicking out annually? This is a lot of money. So if I combine dividend and stock-based, share buybacks, last 3-year average, $6.6 billion of cash outflow. What's their enterprise value? Okay, so $150 billion. What's 6600 divided by 150, 123? That's a pretty thin yield, 4%. Okay, yeah, there it is right there. Mental math checks out, 4%. Well, their share count was 1.6 million shares. It's now down to, yes, you're right. Yeah, they're buying a just metric shit ton of stock back. Good for them. They have the cash. And they've got no debt, so they have something to do. Like, it looks like this number here is pretty clean. The free cash flow per share is growing at 6% a year. They've got no debt. They have a pretty good market position upside. You're buying the stock today. What's today's price? I haven't even looked. $68. So where's my $68? Minus 68 in here. So if I take 68, let's take this times the shares, just to get the current price, current enterprise value. Shares, debt, less cash. Add those two up. So this is the current EV, 100 billion. It's really fallen since this price. Yeah, this last price reading I have in May was 93. It's now 60. It's 100 billion. Wow. Wait a second, guys. It hasn't traded that low since 17, 18 time frame. What are they? What did I say? Free cash flow was 6.6 billion. So that's actually a 6% free cash flow yield. And then EBITDA, at least trailing EBITDA, 14x. So EV, EBITDA, yield, market multiple. Is 14. And at that 14 has never been that cheap in the last 10 years. I think that tells you a lot of why Bill Ackman's in the stock right now. I mean, if they get their mojo back, let's just say, fast forward, they figure out a shoe, they rebrand, they're back at it, and they're crushing it, and they get back to this market multiple of 22 times. Well, what's 22 times this? So if they get 22x, let's take this formatting. 22x, let's see, just this is like future. Future EV, EBITDA. Right? If the same shares or same EBITDA, then I'll just keep debt the same for now. It's minus this. So this means this is market cap. Shares outstanding, right, is the same. I just use the same number for now. That means price could be 1,500. That's not right. There's no way it's 1,500 a share. What did I do wrong? Oh, $104 a share. I divided it twice. So that's a doubling of the stock. Let's see if we put a simple forecast in here. You guys have any ideas of what you want to see in the forecast? I don't think they're expected to make much this year. Let's call it another 5% down and maybe 5% up, like that. What do you think? EBITDA, give them a little struggle. This number is pretty clean without the debt. Yep, I like that number. And then a market multiple. I don't think 18 is unreasonable for this stock. So you get a market multiple expansion from 14.4 to 18. Trailing 12 months, 6.1 billion. CapEx is 600 million. Yeah. Yeah, like it's got a lot of cash flow. 5.5 billion of free cash flow, can pay off the dividend, buy back stock shares, no problem. Totally agreed. Absolutely. This is interesting. This is guys, this is really interesting. 18 times, the average is 22 times market multiple. I'll give this 20. I'm not going to give them the full average. 22 times is high. I'll give them a 20 handle. That's still high. But, you know, if they get their fashion mojo back, they're growing at 5%. They can grow faster than that. They have historically 6%. That's $142 a share, 124 at the yield. That yield's going to come down 0.035. That could be 160. Like they were averaging their yield. Yeah, average yield is 3.5. So I'll go with that, 3.5. That gets me $160 price target. I buy it for $68 today. I get this pro rata share. I'm at 150x. I'm a 15% IRR stock. Let's do a little 68, 75. That's fine. And I need to do this. Let's clear all this stuff up. 68 right there. I forgot how to do scenarios. Alt W V. How do you run scenarios? I forgot the hotkey. Oh, it's been too long since I did this. Where are scenarios? What if analysis? Data table. Insert row. See, scenario T data table. That's what I want. Enter row. I want this number here. There we go. So 15% IRR if it's $68 a share. If it drops to 60, it's 17. What price did Bill Ackman buy this thing at? He must have been picking it up pretty recently, right? So he's in the 80s. I like this stock. This is interesting. 15% IRR. Global brand, more current assets than liabilities. I think this is a trifecta, ladies and gentlemen. I think we just hit a trifecta doing the first live stream. This is it's worth a little single malt scotch here. What do you guys think? That's a very interesting, very strong return. over 10 years, you're beating the market by 50% at that level. He got it in 85. I mean, it's at 68 now. It's nothing like having him in front of you. I think there's opportunity to cut costs in this P&L. And if Ackman is in their ear, he's got enough shares to maybe at least get the CEO to pick up the phone call. He could cut some shares, cut some heads, get profit back, get the mojo back, and turn the corner of the stock, and you could it could double while you sit back and collect the dividend. That's not a bad deal. Yeah, really, really, a very fascinating company. Let's see if they say anything in their earnings. Let's see. Here's their report. Let me pull that out. So let's see. First quarter revenue, $11 billion, down 10%. That's not good. Nike direct revenue down 13%. That's going to hurt. Wholesale revenues were $6.4 billion, down 8%. Gross margin increased 120 bips to 44%. Diluted earnings per share 70 cents. Youch. First quarter statement. Revenues were 11%, down 10% compared to prior year, and down 6% in currency, 9% in a constant currency basis. Ooh. Inventory were $8.3 billion. So inventory went down compared to prior year. Flexible mission. Cash went to $10 billion. That's higher than approximately 15, up 1.5 billion over last year. Dividend, yep. Share purchase, a lot. Okay, let's change our model. Let's give a little bit more of a haircut to revenue. We're going minus 10%, minus 5%. Bring that down. That means that's a 13% IRR. How long can they lose and still make above market return? Wow. They can lose for several years in a row. There you go. You start bringing the market multiple down, it hurts. Oops. But let's just say they can kind of turn it around and get their 18 to 20 times, 18 to 20 times back. Even if they pick up a couple years. Right? So you're 13% IRR, you're still beating the market. That's a nice little stock right there. No telling if it's gonna. Looks like it has kind of some momentum, but might be worth picking up, guys. Might be worth doing. Yeah, I think you're right. I mean, there's a lot more competition in the market. You got Lululemon, you got Alo, the founders here in LA. They're a big brand. You've got the shoe companies nipping at the heels, no pun intended. So yeah, maybe the growth, although really their growth has been mid-single digits for a long time. I think honestly, it's the market multiple compression here that's really weighing on the stock. There's no reason for this stock to be trading at 20, 30 times EBITDA. I think that was way over its skis. And if it can grow at 5% a year from now on, it's an 18, 20 times handle company. That's fine. And that should be more than willing. You don't need this stock to get back up to 25 or 30x to really give you what you're looking to do. You need 20x and you need 5% growth. Put this back. And maybe they can get at least some of that out of pricing pressure alone. Same thought on Pepsi as well. I don't know. Pepsi? Last I thought, Pepsi hasn't grown their EBITDA in a decade. I'm going to save this Nike one down. I'll write the one pager up and publish it just for fun. I want to take a look at Pepsi because I've seen several people have said something about Pepsi, but if I recall, Pepsi had not, I could be wrong, had not grown their earnings in a while. Ooh. It's been a while since I looked at that stock. 17 billion in earnings, but look prior to that's super flat. See that? So you get this EBITDA here. I don't know if that's acquisitions that they've generated or if it's, I'm getting way off topic by way of, but like how much profit growth do you expect in a giant food conglomerate like that? I don't know. It's not a brand for me. Let's go back to Nike. Any last questions or follow-ups on Nike? What do you guys think? Let's see. So Nike can successfully regain customer interests. It's necessary to return to its growth strategy. It's a very good question. The upcoming quarters, especially in Q4, will be critical to answer the question. Yeah, I agree with you. Look, this product is a luxury. It's a premium brand. It is not as fundamental to our society as, say, Amazon, Google, Facebook. It's not like a GlaxoSmithKline or United Healthcare stuff I covered in the past. It's not what else? Caterpillar. It's not Black and Decker. Illinois Tool Works. Snap Tools. None of those. It has none of those real core economic powers that you would expect. It is definitely a consumer brand, and consumers can change their mind. So I think you kind of run that risk, and that's a good point. I mean, maybe we need to let this thing bottom a little bit more so that you can have a little cushion for the fact that it's not, it's not critical to the economy. And there are a lot of very high quality brands that are coming in the market and taking bits and pieces away from this company in the shoe space, in the clothing space. Who knows? They really gotta get their mojo back. Yeah, I would like to see more statements and more action from the CEO. If I were him, I would take all of the bad actors in the business, all the financial trouble, anything that's been like looming that you want to get rid of, but didn't want the shares to take a hit or the market to be bothered by you cleaning house, and I would do it right away. Get all that out so you can start building the business you want, because the market's going to give you a pass for, a good year while you kind of get into your role, understand the players, and begin to make actions that will set the long-term trajectory. So I think you're right to watch the quarterly announcements. I don't know if he has a Twitter account or X account. Follow him on X. Watch him on LinkedIn, see what he posts. And perhaps you can get a feel for how he's moving through the business model. And if you get confidence that he can cut heads, that to me would be someone who is very financially prudent and is really targeting earnings in a strong way. That'd be a real big sign for me. Yeah, I'm not huge in the the consumer brands because they can be fickle. I like healthcare stocks. I like mining. We talked about gold earlier. I like oil companies. I like Meta, Google, Amazon. I've referenced those a couple of times now. Really, companies that are interwoven into the global infrastructure, like banking stocks, J.P. Morgan Chase, for example. These companies are night and day above Nike in terms of their staying power in the economy. So if you're not 20% IRR or more, maybe it's not worth the risk here. Technically, it's beating the market, but I'd rather have that kind of return on a JP Morgan. I'd take that over Nike. Anyways, food for thought. What do you guys think about the live stream? Is the quality decent? Any glitches over this time? Should I change any of the way that I'm screen sharing or it appears on your side? Go back to the main camera. That's better. Yeah, give me any feedback you have. I'm interested in doing a bit more live streaming, so I'm happy to take some questions or just give me some feedback on how it looks from your end. Thank you. Thanks. Charts one, focus one. I like that. Love the live stream. Thanks, guys. Appreciate it. I was kind of like out on the limb here. Just said, F it. Let's just try it. But maybe we can do some of these more often. I'm traveling in my new role. I'm running two companies at the same time. So it's been, needless to say, difficult. But I'm traveling more. I'm on my laptop, so if I can live stream, I will. If I'm home, I'll do it. If I'm at the hotel late and their internet speed's fast enough, I'll try to do it there. Thank you very much, guys. Really appreciate that. Well, I think I'm gonna sign off. It's late here, and I followed VFC. Yeah. I have not looked since they changed CEOs, but I did look at the company for a long, long time. It was definitely undervalued. They've got a lot of great brands, if I'm not mistaken, like Vans, Timberland. It's been a long time. JanSport, a lot of phenomenal brands that that company has not been able to really grow in a meaningful way. Maybe with the CEO, it might be interesting. Yeah, might be a turnaround story. Better be cheap though. If you're going into a turnaround story, you want to really have a deep discount. For example, I just filmed, before I did the live stream, I just filmed my Meta update. I'm going to release that here probably in 2 weeks. And that is an example. If you go back to look at the stocks, the couple videos that I did, that is a true turnaround story with a discount at the time you could have purchased it, which was absolutely legendary. This one is cheap, but oddly, it's not even as cheap as Meta was the time you could have purchased it, the time I call it a trifecta. So, if you ask me would I've taken Meta at that price or Nike at this price, there's no question. So sometimes it's about scale, and this is getting good, but maybe it's not as good to really say how I'm going to dive in here. Yeah, man, it was amazing. I published the video. It was $113 a share. It's now $700. I made 600% on the stock. Called it a trifecta. It was amazing. No, I need to look at Intel. I absolutely need to look at it. You guys are right. They have, they spent that. This was many years ago. They announced a 5-year CapEx build project. that they were getting government support, and they kind of said, "Oh, we're going to be contract manufacturers." They kind of changed business models. Now the CEO is out. I think the CFO is running things kind of intermittently as they find the new CEO. Perhaps what they should do is really lead into the new, building infrastructure in the U.S., make semiconductors here, but that's going to take. I mean, one plant takes 5 years to build, so that stock needs quite a long runway. Yeah, Meta at $90 is a godsend for sure. It's like you look at that thing, you zoom out. I do it in the video. You zoom out, you look at. That's probably, and I say this in the video, I think it was the cheapest in terms of a market multiple basis it's ever been in its history. Back in 2022, you could have bought it for 7 times EBITDA. Yeah, I can do it Intel video. I'll look into it. It's interesting. Thanks for the comment on the 18A processing node. All right, gang. I'm going to call this a day. It's a great first attempt. We'll get better and better at this as we go. Thank you so much for the time. I think I'm going to try to link this to X and push out on across a couple live streams, but wanted to try this one first, get some chat going. I'm glad you guys responded. It's nice to throw the switch and know someone's out there. So really appreciate the time. Have a great night, guys, and we'll chat later. Thank you. Bye-bye.